The Biggest Fraud, Part 3, Investment Implications. One of the things that made us suspicious about COVID and the official science to begin with was just a kind of instinctive antennae against the lack of objective debate and being told this is something the official scientists have determined. We're not going to enter into any debate, and you, as a member of the population who are responsible, must accept that and not question it. And I think just that obviously doesn't appeal to my personality, but doesn't appeal to my profession either, which is based on trying to do my own research and identify objective truths through the analysis of facts. So what we had in COVID was an event that caused surprise, panic, hysteria, and suppression of debate. One of the cult novels of the year has been a revival of Albert Camus' La Peste, or the Plague, written in 1947. And it's well worth a read and contains some choice quotes which I think are useful in the analysis of COVID. Firstly, there have been as many plagues as wars in history, yet always plagues and wars take people equally by surprise. It may seem a ridiculous idea, but the only way to fight the plague is with honesty. But again and again, there comes a time in history when the man who dares to say that 2 and 2 make 4 is punished with death. And the question is not one of knowing what punishment or reward attends the making of this calculation. The question is knowing whether 2 and 2 do make 4. So I think Camus, in a slightly different context, was highlighting the importance of dealing with events as significant as a plague by not panicking, by analysing the facts and determine the truth, and that being the more important aspect in terms of society coming out the other side successfully. So we've certainly been accused of being armchair epidemiologists, accused of being difficult in not just following the official science. And indeed, if we have a different opinion, that opinion being somewhat subversive. I think I'd point out that as fund managers, we're practically armchair everything. So we never worked in any of the industries that we invest in, but dare I say, it hasn't stopped us generating a degree of expertise in analysing those industries. And I think in terms of COVID, whilst I had no interest in epidemiology before this year, certainly I would have been remiss of me not to have had a view on what has turned out to be the greatest crisis that we've faced since World War II. So doing our own research on COVID, having a view on COVID, and having a view that is different from the conventional view is, as Dr. Bernard Roux in The Plague would have said, carrying out our profession. So I think there are a number of skills that fund managers have, which lends itself to analysing COVID. Firstly, the understanding of cognitive biases in expert opinion. We have access to a lot of expert opinion being fund managers, and I can tell you that relying on expert opinion too much is the road to ruin. Expert opinion is very rarely consistently correct in their judgments. Expert opinion is often biased to certain outcomes, whereas the the oil analyst will always think that the oil price will go up. The epidemiologist always thinks that the virus will be worse than it otherwise might have been. The risk, the career risk, if you like, will always point the expert in a certain direction. Fund managers also need to take real-time decisions based on knowledge which is incomplete. And I think, certainly I'll give you the analogy of asking an analyst to write a report on stock and how useful that would be if they came back in a year with their conclusions. The stock price would clearly be different, and whether the stock would make a good investment would have entirely perhaps changed in that particular year. So we look at scientists that say we'll only know in a year what the impact of COVID would be as being particularly useless. Fund managers recognize, I think, cognitive biases in expert opinion, recognize that we have to make real-time decisions based on incomplete knowledge, but also we're also understanding that as facts come out, the truth will evolve. And certainly our conclusions are based on probability. Probability is never 100%, and certainly we're accepting of that. So in our research process, it's very important that our analysis is evidence-based, that we seek an objective truth, and certainly when that objective truth is contrarian, we think it's unlikely to be priced in by the stock market. So already in 2020, we successfully identified massive corporate fraud in 3 different companies. Wirecard, which is one of the biggest companies in Germany, which went straight from the DAX 30 to insolvency. NMC Healthcare, which went straight from the FTSE 100 to insolvency, and its sister company Finera. The reason why we research those companies is identifying stock market frauds is part of our long-short strategy, so that when we find something that we think is a bit smelly, we do research on it and we're convinced it's a fraud, as part of the short book, which hedges our market risk, we are betting against those shares, and in these cases betting that those share prices will in fact go to zero. So the same skills that we've used in terms of forensic analysis that we applied to Wirecard NMC, we've also applied to the science behind lockdown and the claim that the vaccine is the only long-term solution. And certainly we found both of these to be unconvincing. Our analysis is evidence-based. Every fact is referenced, and please go ahead and check the extensive footnotes in the blogs online. And we also understand that new facts will emerge and our understanding of the truth will evolve, and that's all part of how we do our analysis. We don't say that we know 100% for certain what the truth is, but our analysis is based on the facts to hand, and is also our analysis. If new facts evolve, we keep our minds open to that. I think it's also important to say here that we are not talking our own book in coming to these conclusions of COVID. We had a record good month in March where the fund made 15% because we had positioned in advance for COVID to be initially a negative event, certainly in our investment world. And certainly that negativity were to go on for a long period of time, then the portfolio that we had at the end of March would have continued to do extremely well. However, we felt uncomfortable as we went into April that in fact COVID wasn't as bad as we had initially thought, and that the truth was that the outcome should logically be less bad than we initially thought. So in fact, quite the opposite of talking our book, we're actually talking against our own book, and in fact our conclusions on COVID led us to change some of the positions that we had in the portfolio. And I think the other thing to point out is that although we have 100% conviction in our analysis, our portfolio is certainly not positioned for binary outcomes. So everything back to normal tomorrow, just because I've written an interesting blog, is not something that we're positioned for, but similarly we're not positioned for lockdown forever. It's certainly our opinion that just like it took 2.5 years for the market to come to the same opinion on Wirecard and NMC as we have, it could take a lot longer than it should be healthy for the market to come to our view on COVID. So we're certainly continuing to hedge against further misinformation and against further policy error, because frankly, a rational response from a responsible government is not something that we necessarily want to bet the house on. And I think, finally, as long-short investors, we can and do hedge for negative outcomes. That's the whole point of long-short, in that we have a short book to hedge the risk of bad things happening in the global economy and in the stock market. But we'd sort of point out that the wider economy and society can't hedge those risks. So, obviously, whilst we have a professional hat on here, we also do have, some view on what would be in the wider best interests of the economy and society. So let's look at COVID in a historic context. So what do I mean when I say it's been the biggest negative event since World War II? Well, firstly, let's look at the economic damage that I wouldn't say COVID has done it, but our response to COVID has done it, including lockdowns. So this is UK monthly GDP since 1997. So you can see here the size of the economy over the last few months has shrunk to the same level as what it was 18 months ago. So obviously we're not expecting things to be quite this bad for a long period of time, and certainly we will expect some kind of V-shaped recovery, simply because if the economy emerges from lockdown, things are going to get better. But lockdown into perpetuity will make society a lot poorer, lead to many more negative outcomes, and that is why the burden of proof must be that lockdown does in fact have some efficacy. And as you know, our view was that lockdown's efficacy was at best unproven, and in certain cases policy error could in fact lead to worse mortality. We can see that the same thing has happened in the US. Note that the US economy has grown far faster than the UK economy since 1997, but nevertheless the economy contracted by 33% during Q2. So these are massive, really unheard of contractions in economies that frankly put the financial crisis in 2008 just pales into insignificance. And we thought that the financial crisis in 2008 was pretty scary. If you look at some of these charts, you see just the economic damage that lockdown has done. We see here the US unemployment rate since 1948. Unemployment peaked at 14%. It's now back to 12, 11%. So it's trending the right way as economies reopen. But you can see it rather pales or puts into significance 10% unemployment that we saw in the financial crisis and in the recession of the early 1980s. And we have to go back to the Great Depression between 1931 and 1939 to see higher unemployment rates of this, and certainly in 1933, unemployment in the US peaked at 25%. So again, it's been pretty unprecedented moves. And then finally, what's the policy response been? Well, the policy response has been pretty much infinite quantitative easing. So this is central banks making asset purchases. And in the US, that's been not just government bonds, but it's actually been corporate and municipal bonds as well. That's obviously led to significant money creation. Something similar has happened in the UK, where the Bank of England has bought government debt. And in fact, what we're seeing is that increases in government spending are being financed by central banks rather than taxation, which is obviously, at this point, that's obviously a pretty good idea, but it does lead to the significant risk that of currency debasement and an illusion that wealth hasn't been destroyed. And certainly you just have to look at the price of gold in the last few months to determine the fact that trust in fiat currencies is currently at a new low. And obviously, whilst that policy might be appropriate, certainly I would argue that it should have been unnecessary, given that the economy should never have been in the sort of trouble that they're in at the moment, with a rational, well-judged policy response. So let's look at some investment implications here. We were writing back in March, and please, for completeness sake, you can obviously look at what we've been writing for the last decade on our website. But back in March, we were saying that the winners in this would be technology and healthcare. Technology obviously has been doing extremely well from an economic and stock market point of view for a number of years now. And what we've seen is, in fact, that lockdown has accelerated many of those trends to, for example, online shopping. We felt in April, when we wanted to add to our cyclicality, that some of the semiconductor stocks would actually do well because of the demand for electronics as people work from home. But what we've generally seen is people hold out in their own homes are certainly more likely to use the internet and all the services on the internet. And obviously, healthcare, unsurprisingly, has also been another big winner. No government can really politically now afford to be seen to be spending less on healthcare, however ill-directed that money and unproductive that money is spent. Some industries won't recover. So, for example, shopping malls, we saw as a sunset industry before COVID. We find it difficult to see how any of them have got any value at all for equity holders now. So we believe that most shopping malls will be insolvent. Others have suffered unnecessarily through policy error. So, I don't think that travel and leisure is a sunset industry, because I think people will always want to go on holiday. But again, the industry has to be significantly recapitalized, given this has been a year without revenue. Even if I think our arguments are accepted, I think that now new behaviour has become habitual. So there was some stigma about working from home before COVID. I don't think that stigma now exists, and I think because people generally don't like commuting and find that they've got an extra hour or two on their hands every day and could be more productive, I think this is actually a pretty long-term change, and I don't think we're just going to go back to normal in terms of commuting into office space. And that means, I think, greater spend on housing, on if you like, people spending more time where they live than in city centres. And that, of course, is going to have a negative effect on the price of assets in city centres. We've also, of course, touched on the fact that we've had this unprecedented policy response, infinite QE from the Federal Reserve. I guess we've also got infinite QE from the Bank of England, although they've not articulated that, and that this QE is monetising the extra government spending. So instead of raising taxes for government to spend the money, the central banks are printing the money. And I think one of the other things to bear in mind is that money spent by governments is not necessarily money that is productively spent. So, I think there's pretty much a scattergun approach to fiscal stimulus in the UK, where certainly it's not difficult to apply for a business loan that many people may end up never paying back. And I think this is going to become a significant issue going forward, that governments should be trusted with the tax revenues to spend wisely. And I think what we've seen with governments is that they've sprayed it around like confetti, and they're obviously realizing that it'd be pretty unpopular to raise taxes to pay for such ill-judged policy response. So in the meantime, they've got central banks to just print the money. That, of course, is not necessarily an ill-conceived short-term policy, and is obviously needed given the mess that they've got us into to avoid a deflationary spiral. But it does risk a significant pickup in inflation in the future. It risks long-term uncertainty about currency debasement. And obviously, if we thought lockdown was a fraud and the vaccine was a swindle, currency debasements probably also fall into that camp as well. And then there are obviously the wider risks of lockdown. We've not yet seen a significant rise in non-COVID excess mortality, and that could be because a lot of people that were close to death from other illnesses ended up being categorized as COVID mortality. But when hospital treatment is withdrawn and the NHS becomes almost exclusively a COVID healthcare service, it's almost inevitable that there will be significant negative consequences for people suffering from other diseases like cancer, that mortality unfortunately picks up in those areas. The economic destruction, there's more than a decade of economic growth gone. A rational policy response would see that economic growth pick back up quite quickly, but certainly from what we've witnessed, might not be too confident that all the policy decisions are going to be 100% rational. We're going to see rising unemployment when furlough ends. Unemployment amongst young graduates is going to unfortunately rise. It's more difficult to train young people when there's no office environment. Social disharmony, we've already seen this pick up. failing education. It's pretty awful that kids aren't getting a proper schooling based on hocus science. And obviously, if we thought that governments and mainstream media were distrusted beforehand, certainly if we're right about the truth about the virus, then I think that distrust can only grow. We've also, quite bizarrely, in our opinion, seen an electorate that's generally been pretty happy with an authoritarian bad government, perhaps the myth of Spanish flu and a second wave has helped governments double down on their propaganda to justify some of the things that they've done. But again, I wouldn't necessarily bet on governments being able to pull the wool over people's eyes into perpetuity. Let's finally finish off with how we think that we will be positioned for this. Obviously, what we're currently seeing as lockdown has eased is that every single purchasing manager's indices is showing a V-shaped recovery. Obviously, those V-shapes recoveries are less robust than what they might otherwise be because they're patchy and uneven and don't include every industry. And the V-shape could indeed turn into a W given further policy errors. So, further lockdowns on an irrational fear of a second wave would be one of those. Governments seem to have become prisoners of their own propaganda. The introduction of face masks at the point at which the virus has pretty much left London and most parts of England seems to be just bizarre. We're seeing random lockdowns and quarantine, and you're scratching your head as to whether why this is appropriate at this point of the infection cycle. Obviously, we've seen unprecedented stimulus. That's going to be pretty clumsy stimulus and have unintended consequences. I think one thing to note, obviously, particularly in the US, it's our opinion that the so-called second wave, which is in fact a first wave in Sunbelt states, is coming to an end and will convincingly have ended it in the next few weeks. Now that might have a significant effect on the presidential election, but it's going to be pretty hotly debated. Certainly, unfortunately, the interpretations of the virus seem to have become very highly politicized, even up to the fact that whether certain drugs like hydrochloroquine taken together with zinc do actually work just because President Trump has said they do. And certainly seems to be quite a lot of opposition to that, not necessarily from doctors, but from people that don't like President Trump. I think one other factor to sort of bear in mind is whether it's not something for this blog, but the origins of the vaccine are still somewhat indeterminable. Whether it was man-made or not, it's certainly a logical conclusion to think if it was man-made, then it could more easily happen again. And if geopolitical tensions between China and the rest of the world continue to rise, then it's probably more likely to happen again. Obviously, we don't know whether it was lab-made or not, but certainly China could have shared information on the virus sooner than it did, and China, of course, has seen its relative role in the world expand as its economy has actually shrunk less than many major other economies. So concluding, I think the most important thing is to do your own analysis, but to stay open-minded in your investment positions, to stay liquid, and to be opportunist as consensus around the truth evolves, and it will be the consensus evolving rather than individual fund managers who influence share prices. Secondly, things, despite the really difficult economic data, I think we've got to consider that this monetary debasement, which is unprecedented, is bullish for asset prices. Whether it results in wealth creation is another debate, but it is very bullish for asset prices, which is why stock markets are one of the reasons why stock markets are more robust than the real economy. The other one being that stock markets are obviously anticipating economies recovering. And I think finally, there will be a number of industries that don't recover, and we also think it prudent to be hedging our market risk through a short book of companies that we've identified as particularly as risks for their equity holders. Putting this all into context and giving a little bit more background on what we do, I've been running funds for 17 years and a long short strategy for over 10 years. The identification of fraud along with overhyped growth and value traps has been successful part of this short alpha generation. When we talk about short alpha, this is the difference between our returns and the market returns. So the idea is if you can combine short alpha and a long alpha, you basically double your alpha into what we have determined to be called double alpha, and that, if you like, gives us a strong uncorrelated return to the vis-a-vis the market. So we very much believe that long short, which leads to uncorrelated returns, is the future of active management, and that we very much complement cheap passive beta with a return profile that is uncorrelated, and certainly we will continue to try to invest successfully both on the long and the short side in order to generate this uncorrelated return profile for our investors.